Hi everyone, and thank you for tuning in. In this video, I'm going to take a deep dive into Nvidia's second quarter of fiscal 2023 earnings call transcript. Now remember, every company has to report a quarterly financial statement. Along with those financial statements, typically a company will hold a conference call where it will discuss the figures in the earnings statement, give a little explanation in the first part of the earnings call, and then we'll take questions from analysts that are following the company. And so this is a deep dive into Nvidia's most recent earnings call that was held on August 24th, 2022. So let's get into it. So here you have Nvidia's CFO and Executive Vice President Colette Kress giving her, opening statement, and she cites some important figures about Nvidia's quarter. Right off the bat, she says this was a challenging quarter, and it was. Total revenue of 6.7 billion was down 19% from the previous quarter and 3% year over year, and it was below the 8.1 billion that the company forecast it would hit in that quarter. So not only was it below year over year decrease, but it was also below the company's estimate. So it was worse than they were expecting. Now, for a company like Nvidia that's been growing, robustly over the last decade, to have revenue decrease year over year in a quarter, it's a significant pullback from the growth that they'd been achieving. And, moving along here, the revenue of 2 billion was for its gaming segment. Revenue of 2 billion was down 44% sequentially and 33% year over year. So that's the biggest area where Nvidia is experiencing decreases in sell through, and so that reflects challenging market conditions. As they discussed in May, they expected a sequential decline in gaming revenue due to the softness in Europe related to the war in Ukraine and COVID lockdowns in China. The decline in gaming GPU revenue was sharper than anticipated, driven both lower unit sales and lower ASPs. ASP is shorthand for average selling price. So not only were they selling fewer units, but those units that they were selling were going for lower prices. Moving along here now, it's important that for you to understand that Nvidia's graphic processing units are also used in the process for mining cryptocurrency assets. And so the sales of Nvidia's GPUs are correlated with the prices of cryptocurrencies. And in recent quarters, prices of cryptocurrencies are significantly below their highs. So when prices are lower in cryptocurrencies, fewer individuals are interested in mining the assets or paying for these GPUs, developing a system to mine these assets. And so because of that, that's causing a decrease in sales of Nvidia's GPUs. But the CFO notes here that they are unable to accurately quantify the extent to which the reduced crypto money contributed to the decline in gaming demand. So they know that the decrease in crypto prices is affecting the demand, and they're seeing it with the decreases in revenue, but they're unable to specifically or accurately quantify that decrease. How much of their softness in sales is driven by this, they still don't know. The CFO also notes that Nvidia's GeForce GPUs are the most coveted brand by gamers, representing 15 of the top 15 most popular GPUs on Steam. Steam is a popular gaming platform, and so Nvidia's GPUs are top of the line in the industry. Gamers are it's one of the favorites among gamers. Nvidia's GPUs are the ones they use. In fact, during much of the early stages of the pandemic, their GPUs were sold out in traditional channels like Best Buy or uh, uh, Target or Dell, where you would buy these computers that included GPUs inside them. They were mostly sold out because of such high demand. Only recently has inventory picked up and started to show some availability, and that decrease in demand has been dramatic actually. But still, even in their professional visualization, wow, that's hard to say, revenue was of 496 million, was down 20% sequentially and 4% from a year ago. Macroeconomic headwinds intensified and enterprise demand slowed, and OEM, original equipment manufacturers, worked to reduce inventory. And this is typical when there is a macroeconomic decrease in activity. Their businesses are less interested in investing in these types of services and these types of new technologies during moments of decreases and uncertainty in macroeconomic demand. So moving further, Nvidia's automotive segment is also a robustly growing segment, and you think of where they have a presence, it's mostly in the driver cockpit, where you have your dashboard system, where you have your radio, your temperature controls, and all those systems that are in the front of the car. That's where it has a significant presence. And it's also widely used in self-driving technology in driverless cars. And so that's a growing segment, and revenue in this segment grew 59% sequentially and 45% from a year ago. So this portion of its business is doing really good. It's not affected by the macroeconomic headwinds hitting the other sectors of the business. During the quarter, they announced rollouts of plans from new OEM partners. Remember, OEM stands for original equipment manufacturers, like NIO, Li Auto, Jidu, Human Horizons, as well as Pony.ai. All of those line of self-driving trucks and robo-taxis are all built on NVIDIA's driverless technology. So looking forward, they expect that $11 billion automotive design win pipeline to translate into continued growth. So that's one part of its business, at least, that investors could look at in this recent quarter and say, okay, that was a good sign. That's something that we can look at and say that quarter wasn't as bad as it seems. So some of the key areas where Nvidia is experiencing growth, the CFO mentions, is in natural language processing, recommender systems. Recommender systems are like, what song Apple Music will recommend to you after you listen to one song, or what movie Netflix will recommend to you after you watched a certain movie, or if you visit a website and you clicked on a certain product, which other products would it recommend to you? This is a rapidly advancing industry, and Nvidia is playing a large role in that with its graphic processing units. And then, of course, we already talked about autonomous vehicle and cloud training and cloud graphics as well. Here's something significant in the quarter that the CFO highlights here is that gross margin included a $1.22 billion charge for inventory and related reserves based on revised expectations of future demand. So what this means is that Nvidia ordered a certain amount of inventory that they were thinking they were going to be able to sell at certain prices, but based on the results they're seeing from this recently completed quarter and going forward, they needed to write down what the value of that inventory was, because they realized they're not going to be able to sell all of it that they were expecting to sell, and the ones that they do sell, they're going to have to sell it at lower prices. Remember earlier the CFO mentioned lower ASPs and lower unit sales. And additionally, Q1 included a $1.35 billion acquisition termination charge related to the ARM transaction. This was recall when Nvidia attempted to acquire ARM and the deal fell through, and because the deal didn't consummate, Nvidia had to pay ARM a $1.35 billion termination charge. So going further, Nvidia discusses their capital return program, and they highlight that during the first half of their fiscal 23, they returned $5.5 billion to shareholders in the form of share buybacks or repurchases and cash dividends. They plan to continue repurchases, and they have nearly $12 billion remaining under their authorization. So that's good news that even though they're experiencing these headwinds, that management feels their stock is undervalued as the price has came down. And then they also give their third quarter outlook, and they say they expect gaming and ProViz revenue to decline sequentially again, and as inventory comes down as they prepare for a new product generation. So not looking good for the next quarter. Revenue is expected to be 5.9 billion, which is going to be another year-over-year decrease. And in fact, after this quarterly conference call was released, Nvidia highlighted that there was a government restriction in terms of the chip sales to China and Russia, and that might bring sales in the third quarter down 400 million more. So the expectations, if you include that for the third quarter, could actually be 5.5 billion instead of 5.9. So the third quarter is looking to be another difficult one for Nvidia. So moving along, that first portion of the conference call or the earnings call was prepared remarks by the company. This second half that I'm going to go through, and it's highlighted in green instead of in yellow like I did above, are management, the CFO and the CEO responding to questions from analysts, right? So they did their spiel, and now analysts are asking them questions about everything that they said, things that got on in the quarter, things that analysts are curious about. So in this first question that came from the analyst from Evercore ISI, Christopher Muse, Christopher asked a question, and so the CFO responds to it saying, across those two quarters of Q2 2023 and Q3 23, we likely have undershipped gaming to our end demand significantly. We expect that sell-through, or essentially our end demand for those combined two quarters of Q2 and Q3 to be approximately 5 billion. So what the CFO is referring to here is that Nvidia does not usually sell its products directly to consumers. Instead, it sells to channel partners like Dell, which then includes it in their computer builds, or to Best Buy or to Micro Center, certain of these businesses that have their products. And so what Nvidia is doing now is reducing the sales, the availability to those partners, because right now there's an excess inventory in the system. And so the CFO says that we're restricting supply because there's so much supply in the system right now. We're going to restrict it and let these amounts sell through before we boost production and boost supplies again. In continued response to the slowing demand, CEO Jensen Huang chimes in here and saying that, you know, like even though current demand is slow and decreasing, look, if we take a bigger picture, the sell-through has increased 70% since before the pandemic. So sales are up 70% since before the outbreak. So that puts it into perspective, like, okay, a pullback here was to be expected. There was a major boom since the pandemic onset, and so a little bit of a pullback was, is not really surprising and should not set off a panic among investors. And again, the CEO also follows what the CFO said, and their strategy is to reduce sell-in, so not provide the channel partners with the inventory. So let those products sell through the system and let inventory in the system reduce. And so let the channel inventory correct. Obviously, we're off the highs, right? We're not experiencing those high sale throughs, and the macro condition turned sharply worse. So this is a little bit refreshing to hear a CEO just come out and straightforwardly, transparently say, yes, our macro conditions, our demand has turned sharply worse. He's not trying to sugarcoat it here. He's not trying to say this or that. He's just saying, yes, it turned sharply worse. And this is what we're doing to correct the issue. So that's refreshing. I like to see that from management. And so again, talking about the steps they're taking, they reduced sell-in to let channel inventory correct, and they've implemented programs with the partners to price position the products, meaning allowing them to sell these products at discounts, offering promotions and all of this to make sure that this existing inventory gets sold to make room for this next generation of products that they're developing. So to make sure that when the next gen comes out, the older generation models are not sitting on the shelves still. So here's an interesting little tidbit that the CEO Jensen Huang goes through in the conference call, um, highlighting that the deep learning based recommender systems has demonstrated such significant effectiveness, and it helps internet service providers to enhance engagement, enhance click-through rate. And so that's particularly um, helpful in selling these products, right? Because if if you're a Netflix or if you're a Amazon and you rely on giving your customers the right recommendation at the right time, if Nvidia's products help you increase that click-through rate and increase those sales, you're going to be more interested in buying Nvidia's products, right? Because they're earning their value. You're paying perhaps a certain price per unit, and that price, whatever price you're paying, is giving you a return on investment of 150% or 250% or whatever the figure might be. So if that return on investment is effective, then those providers are going to be interested in purchasing these products, and which the CEO is noting that that's the case, that their products are proving to be significantly effective. So that's good news for the long-term effectiveness of Nvidia's GPUs, is that they're providing these businesses more return on investment. So as long as that return on investment is there, businesses will keep purchasing those products and upgrading to the next level technology, because that's earning them even more money. So that's not an area that they're going to cut back on when there's a recession or when sales slow down, because this is an area that is delivering them direct and immediate returns on investment. And so this is not an area businesses like to cut back on during recessions. I'm gonna end with this final statement here, and it's it was an interesting little comment that I found to be important for the long term of this company, because remember we noted that the automotive segment of its business is growing so much faster than the rest of its business, and driverless technology is, it's coming. It's many businesses are investing, Tesla being the most notable one, and Alphabet has Waymo that's also investing in driverless technology. And so you have several massive businesses that are investing in this, and the segment is growing, and it's growing fast, and there's no signs of this industry slowing. If anything, it's going to accelerate further. And it's interesting to note here that the CFO says that the automotive industry is below our company average, and she's talking about gross profit margins here. And so that will offset some of the upper bound things that we see in terms of data center. So as the automotive segment of its business grows and becomes a larger share of its overall sales, that could work to lower its gross profit margins, which Nvidia has been notorious for delivering excellent gross profit margins. But as more of its business becomes in automotive, that's going to work to decrease its gross profit margins unless it is able to change something structurally to be able to raise the prices and raise the profit margins in that segment. But I thought that was interesting here that the CFO notes this in its fastest growing segment of the business and one of its premier long-term areas of growth. So I thought that was interesting, and I think that's an interesting place to end this video on, is something to think about. That okay, so automotive is growing faster than the rest of your business, but it is coming at the expense of gross profit margins. It's not as high as the rest of your business. So I thought that was interesting. Anyhow, that's all I've got for Nvidia's earnings call deep dive. Thank you for watching, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for all investors of all skill sets and risk levels. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 3 times. Go to fool.com/Parkev to get your 10 stock picks now.